This video illustrates how at-risk can be used to examine a financial portfolio of stocks. An investor is going to purchase shares of 5 stocks and then sell them in 6 months. To hedge the risk of this portfolio, the investor is thinking about purchasing put options on the stocks. These have value if the stock prices decrease, as will be discussed in more detail later in the video. The main goal is to estimate the return on the portfolio, with or without the put options. It helps in an example like this to have historical data on the stock prices. From historical data, the mean growth rates of the stocks and their volatilities can be estimated and used to project into the future. Here is the historical data for these stocks. Their monthly closing prices are listed in columns B to F. The usual way to estimate the mean growth rates and volatilities is illustrated in columns G to K. The logs of 1 plus the returns are calculated for each month, and their averages and standard deviations are then calculated. Then the annual mean growth rate is 12 times the monthly rate, and the annual volatility is the square root of 12 times the monthly volatility. Here is the portfolio model without put options. The current stock prices appear in row 3, and the numbers of shares purchased are in row 4. These purchase quantities could be treated as decision variables, but here they are assumed to be fixed. The values in rows 6 and 7 are estimates from the historical data. The future stock prices in row 10 are modeled with at-risk distributions. Specifically, they use the well-known log-normal model of stock price changes shown in the equation. Here, P sub t is the stock price at time t, P sub 0 is the current stock price, mu is the mean annual growth rate, sigma is the annual volatility, and z is a standard normal random variable, implemented with the risk normal 0,1 function. Note that at-risk's dice button is toggled to static. So the stock prices shown here are those where the random z values are set to their mean, 0. With these values, you can see that the portfolio return is 8.03%. However, if it is toggled to random, the stock prices change randomly when you press the F9 key to recalculate. As you can see, the stock prices and the corresponding returns change rather dramatically because of the large volatilities. In this example, I have designated only one cell, the portfolio return in cell C14, as an at-risk output cell. However, if you want to see how the individual stock returns vary, you can designate any or all of the stock returns in row 13 as at-risk output cells. Also, I have asked for the mean portfolio return, the probability that the return is positive, and the value at risk, or VAR, of the portfolio return, which is typically defined as the 5th percentile. Remember that such summary statistics are valid only after you run the simulation. They can be meaningless or even errors before the simulation is run. Now I will run 5,000 iterations of the simulation. Here is the distribution of the portfolio return. As you can see, this distribution is slightly skewed to the right, with possible values ranging from about minus 25% to around 60%. The mean portfolio return is close to 10%. The probability of a positive return is about 80%, and the VAR is somewhere between minus 7 and minus 8%. In words, the investor now knows that there is only a 5% chance of having this bad a return or worse. The investor is now also aware that there is a lot of variability in the portfolio return, so that the return from the static values is misleading at best. So far, the investor has a fairly risky portfolio. There is certainly a lot of upside potential, but there is also a significant downside risk. One way the investor can reduce this risk is to purchase put options on the stocks. A put option allows the investor to sell 100 shares of a stock at a fixed exercise price at a fixed exercise date, here taken to be 6 months from now. The idea is that if the stock price drops below the exercise price, the investor can sell high and buy back low. For example, if the exercise price of the stock is $24 and the price in 6 months drops to $23, the investor can sell the stock at $24 and buy it back, that is, cover his position, at $23, earning $1 per share. If the future price is above the exercise price, the investor will simply not exercise the option. This strategy means that the investor is covered in both directions. If a stock price increases, the investor makes money on the stock and lets the option on the stock expire. If the stock price decreases sufficiently, the investor loses money on the stock but gains some back from the option. So this strategy should have less risk. The model shown here is the same as before, except for the put options. The numbers of puts purchased are listed in row 9. Their exercise prices are listed in row 8. And their prices are calculated in row 11 from the well-known Black-Scholes formulas implemented on the right. The risk-free rate, assumed here to be 5.5%, is used in the Black-Scholes formulas. The portfolio return with outputs is the same as before in cell C19. The new outputs are listed in rows 20 and 21. The values in row 20 are the gains from the puts at expiration. Each is either 0, meaning that the put isn't exercised, or the difference between the final stock price and the exercise price. Then the portfolio return with puts in cell C21, another at-risk output cell, is the return from the entire investment. That is, it is the percentage change from what was spent initially to the final value of the portfolio. The values you see here are based on means because the dice button is again toggled to static. However, if it is toggled to random, you can see how the portfolio return with and without puts changes. The portfolio return without puts is consistently a little below the portfolio with puts. But is this necessarily bad? The simulation will shed light on this. Again, I will run 5,000 iterations of the simulation and then compare the distributions of the two outputs. As you can see from the histograms and the summary statistics on the worksheet, the difference isn't as large as the investor might expect or like. There is the histogram with outputs. There's the histogram with puts. There is still about a 20% chance of a negative return. And the VAR is only slightly less negative with puts. In fact, the upside potential is slightly less with the puts. Of course, these results are for the particular puts entered in rows 8 and 9. Perhaps the investor can manipulate these to get more desirable results. Another way to modify this model is to introduce correlations to the stock prices. After all, the stocks tend to react to the same economic forces, so they are likely to be positively correlated. Here's the same model as before, but with correlated prices. I created these with the defined correlations tool using a correlation of 0.7 between all pairs of stocks. This introduces the risk-cormat function into the formulas for the stock prices. The question is whether this will make much difference to the portfolio returns, with or without the put options. I will again run a simulation with 5,000 iterations. First, to make sure that the stock prices are indeed correlated, I will look at a scatter plot of stock 1's price, shown here, versus stock 2's price. Sure enough, the correlation between these is about 0.7. Here are the histograms of the portfolio returns, the one without puts and the one with puts. As you can see, they are much more spread out than before, although there is somewhat less variability with puts. You can see the same behavior in the summary statistics. For example, the VAR is much more negative than in the uncorrelated case, although it is not quite as negative with puts as without puts. The point here is that the investor is putting all his eggs in one basket when he invests in positively correlated stocks. They all tend to move in the same direction, so there is much more potential for really large gains or really large losses. Again, the puts hedge some of the downside risk, but certainly not all of it.